Welcome, everyone. Ready for a really interesting deep dive today?
Absolutely. We're getting into the nitty-gritty of something vital.
We are pulling back the curtain on how companies, well, how they track their money. It sounds simple, but it's fascinatingly complex.
And we'll see why auditors are so incredibly important in this whole picture.
Exactly. Today, it's all about the revenue cycle and the expenditure cycle. These are really the core engines of any business's finances.
Think of it as money coming in and money going out. But the how is key.
Right. Our mission today, break down how these cycles actually function day to day.
We'll look at the risks, too, where things can go wrong, intentionally or not, and how auditing steps in to provide that assurance.
Think of this as your shortcut to understanding the financial heartbeat of a company. The sources we've looked at give us a really solid foundation.
Okay, let's dive in. A company's finances can look like just a huge jumble of transactions, right?
Totally overwhelming if you think about it all at once.
But auditors have a smart approach. They don't audit transaction by transaction, not usually. They group things into these transaction cycles.
Sort of like organizing a messy room into labeled boxes, makes it manageable.
Exactly. It's efficient. Less auditors look at related accounts, transactions, disclosures all together. Connect the dots.
So what are the main cycles auditors look at?
Well, the big ones are revenue getting paid and expenditure paying bills. Those are our focus today. But there's also cash, inventory, investments, and then a catch-all other category for things like property, plant and equipment, payroll, financing.
Okay, so let's tackle revenue first.
Yeah.
Simply put, this is everything from making the sale to getting the cash in hand, right?
That's the gist. Covers the sale itself, the money customers owe you, that's receivables, and the actual cash coming in.
Now, you mentioned risks. What's the big worry here?
Fraud risk. This is huge in the revenue cycle. Auditors actually presume there's a risk of material misstatement from revenue recognition fraud in every audit.
Every single one.
Yeah.
Why is that?
Think about the pressure. Management often needs to hit revenue targets. So there's a big incentive to, let's say, bend the rules or even break them.
Okay, so how might that look in practice? What kind of games get played?
Oh, there are quite a few. Our sources highlight common ones, like early revenue recognition, booking a sale before it's actually finalized.
Like claiming revenue in December for something shipped in January.
Exactly. Or holding the books open, literally keeping the accounting period open a few extra days to squeeze in more sales.
Sneaky.
What else?
Outright fictitious sales. Just making them up.
Wow.
Then there's failure to record sales returns, hiding returns to keep revenue looking high.
So the numbers look better than they are.
Right. Using side agreements to change terms secretly, maybe pushing goods onto customers they don't really need yet. Channel stuffing is similar, forcing distributors to buy way more than they can actually sell.
Just to inflate the company's sales figures temporarily. Precisely. And finally, just overstating receivables, either inflating the balances owed or pretending more debts are collectible than they really are.
It's quite a list. So how does a company protect itself?
Internal controls. That's the absolute bedrock. These are the company's own rules and procedures designed to prevent errors and, crucially, fraud.
Their own internal police force, almost.
Kind of, yeah. A good system has multiple checks. Let's walk through a good sales transaction.
Okay. How should it work?
First, preparation of the sales order. Customer order comes in. Sales team prepares a serially numbered order, unique number, easy to track, sends it to credit.
Serial number is key for tracking, right?
Absolutely. Next, credit approval. Credit department checks if the customer is good for the money. If yes, copies go to shipping, billing, accounting.
So not just anyone can approve credit.
No way. Then, shipment. Shipping prepares a bill of lading proof it shipped. Goods go out. Now a receivable is officially created.
The company is owed money.
Right. Then, billing. Billing department makes a serially numbered invoice, matches it to the shipping docs and sales order. Are we billing for what we actually shipped and was ordered? Invoice goes to the customer and accounts receivable.
Lots of matching happening.
Critical step. Finally, accounting. They record the sale in the journal and post the receivable. Done.
Okay, that sounds thorough.
But the most important part, did you notice how different people handle different steps? Sales, credit, shipping, billing, accounting.
Yeah, it wasn't one person doing it all.
That's segregation of duties. The golden rule. No single person controls the whole process. Massively reduces fraud opportunities.
Got it. So segregation is key. What about controls over the money after the sale of the accounts receivable?
Good question. First, recording it properly. It needs to be in the main ledger and the detailed customer ledger. And someone independent should reconcile those two regularly.
Checking that the totals match the details.
Exactly. Then, collection. When cash comes in, the receivable needs to be marked as paid promptly. What about uncollectible receivables? Stuff you won't get paid.
Right, bad debts happen.
Companies track overdue accounts with an aging schedule. If something is deemed uncollectible, it needs a formal write-off, usually approved by someone senior, like the treasurer. You need tight control here so someone doesn't just write off a debt and then pocket the cash if it comes in later.
Prevents misappropriation. Makes sense.
Then sales returns. You need to check the return goods before giving credit. Use a numbered receiving report. And crucially, the people issuing credit memos shouldn't be the ones handling cash.
Again, separating duties.
Always. And finally, sales discounts. Just need clear procedures to ensure discounts are applied correctly so you don't accidentally overstate what's owed.
Okay, that covers managing receivables. What about the actual cash coming in, cash receipts?
Super critical area. How do you control cash when it first arrives? One simple, effective control. The person opening the mail with checks. They should not have access to the account's receivable records.
Why is that?
So they can't steal a check and then just delete the corresponding receivable to hide it. Simple, but powerful.
Okay, what else?
You list all checks received a pre-listing. 3 copies. 1 to the cashier for the deposit, 1 to accounts receivable to update customer records, 1 to general accounting.
Spreading the information.
Right. Accounts receivable then matches the deposit ticket from the bank with the customer payment, slips the remittance advices, catches discrepancies.
And the cash itself.
Stamp checks for deposit only, immediately restrictive endorsement, deposit everything daily.
Right.
Reduces temptation, reduces risk. Things like cash registers or lock boxes help too.
It's a very structured process.
It has to be. And auditors, when they come in, they test these controls. For sales, they'll ask about credit checks, look at documents, maybe observe inventory handling, check those serial numbers on shipping docks.
Making sure the system works like it's supposed to.
Exactly. For cash receipts, they might inspect endorsed checks, watch the pre-listing process, check deposit slips, see how remittance advices are matched.
And they're always looking for that.
Segregation of duties. Is authorization separate from record keeping, separate from custody? That's the auditor's mantra for controls.
Okay, so after testing controls, auditors dig into the actual numbers, performing specific procedures.
Yes. Now they're gathering direct evidence about the amounts on the financial statements. And for revenue, there's a key principle, a pass key. Existence is usually more critical than completeness. Auditors are generally more worried that sales and receivables are overstated, that they don't actually exist or are too high.
Because companies want to look good, so they're more likely to inflate revenue than hide it?
Generally, yes. The risk of understatement is lower.
So how does that affect the tests for sales transactions?
Well, they test multiple things, what we call assertions. For completeness, did all sales get recorded? They might trace shipping docs forward to the sales journal.
Making sure nothing shipped got missed.
Right. For cutoff right period, they check sales around year-end, compare invoice dates, shipping dates, recording dates, look at returns after year-end, too.
No shifting sales between periods.
Correct. For valuation, allocation, accuracy, right amount, compare invoice prices to price lists. For existence and occurrence, did it actually happen? They vouch backwards from the sales journal to shipping docs and customer orders.
Proving the recorded sale is real.
And understandability right classification. Check invoices to make sure sales revenue is recorded as sales revenue, not something else.
Okay. What about accounts receivable itself? What are the key tests there?
Similar assertions. For completeness, get the age trial, balance the detailed list, and trace the total to the general ledger. Make sure the list is complete.
Nothing left out.
For valuation, allocation, accuracy, they look at confirmation results. We'll get to those. And importantly, test the allowance for doubtful accounts. Is the company setting aside enough for bad debts? This is a huge judgment area.
Right, that estimate.
For existence and occurrence, the main test is confirming balances directly with customers.
The confirmations.
And for rights and obligations, does the company actually own these receivables? Check bank confirmations, loan agreements for liens. Ask if they've sold off any receivables.
Okay, you mentioned accounts receivable confirmations. You said they're a big deal.
They are. It's actually a required audit procedure by standards unless very specific conditions are met.
Like what?
Like if receivables are immaterial, or if confirmations just wouldn't work, or if risk is super low and you have strong alternative evidence, if auditors don't do them, they have to document why and what else they did instead.
So usually they have to send them. What kinds are there?
Two main types. Positive confirmations. These ask the customer to respond whether they agree or disagree with the balance shown.
You have to reply either way.
Yes. You use these for large balances if you expect errors or if controls are weak. There's also a blank positive form where the customer fills in the balance, gives better evidence, but response rates can be lower. Auditors also have to verify electronic responses carefully.
Okay, what's the other type?
Negative confirmations. These only ask the customer to respond if they disagree.
So no news is good news.
Sort of. They're less reliable, used only when risk is low, lots of small balances, and you think customers will actually pay attention and respond if there is an error.
Yeah, what do these confirmations actually prove?
Primarily, a customer agrees the debt exists and rights and obligations the company has the right to collect. They are not good for valuation because a customer might confirm even if they can't pay, and not great for completeness because customers rarely complain if they owe less.
Good point. What if the customer does disagree? These confirmation exceptions.
Auditors investigate?
Yeah.
Is it just a timing difference, like payment was mailed but not received yet, or goods shipped but not arrived? That's usually not a misstatement.
Just a delay in recording.
Right. Or is it a true misstatement? Fictitious sale, wrong price, cash stolen, payment applied to the wrong account. Or a real dispute like damaged goods. Those need follow-up.
And what if they just don't reply at all? Non-responses.
Auditors send second, maybe third requests. Might ask the client to nudge the customer. If still no reply, they perform alternative procedures.
Like what?
Inspecting the original shipping documents for that sale, or checking if the customer paid the bill after the year-end date, trying to prove the receivable existed at year-end.
Makes sense. Okay, last piece for revenue. Auditing presentation and disclosure.
Right. Making sure everything is clearly and accurately presented in the financial statement footnotes.
So checking for completeness are all the required disclosures there, like revenue recognition methods, related party sales, types of receivables, any pledged receivables, the bad debt allowance calculation.
Exactly. Checking valuation, are the numbers and the notes accurate? Rights and obligations, are pledged receivables properly disclosed? Understandability, is it all clear? Is the distinction between current and long-term receivables clear? Net realizable value shown. It's about transparency.
Okay, deep breath. That's the revenue cycle. Now let's flip the coin to the expenditure cycle.
The mirror image, essentially. Everything from deciding to buy something to actually paying for it. Purchases and cash disbursements.
And you said the audit focus is different here.
Yes, another pass key. For accounts payable, the main concern is usually completeness and accuracy, not existence. The risk is understatement.
Companies are more likely to hide liabilities than invent them.
Precisely. They want their debts to look smaller, if anything.
So controls are just as important here. How should the expenditure cycle work?
Starts with the purchase requisition. A department needs something, they fill out an approved numbered form, sends it to purchasing. Critically, the department needing the item shouldn't place the order.
Segregation again.
Always. Then, purchase orders. Purchasing gets bids, prepares a pre-numbered PO, sends copies to the vendor, the receiving department, accounting, and the requesting department.
Tracking everything.
Yep. Then, receipt of goods. Receiving gets the shipment. Ideally, their copy of the PO doesn't show the quantity, so they have to count. They check the goods, prepare a receiving report, send it to accounting. Goods go to the department that needed them.
So receiving confirms what actually arrived.
Crucial step. Now, for accounts payable controls. Accounting gets the receiving report. They match it to the purchase order and the vendor's invoice.
The famous three-way match.
That's the one. Ensures they only pay for what was ordered and received. Then they record the payable.
Okay, liability recorded, how about paying it?
Approving invoice for payment. Accounting reviews that whole matched package invoice, PO, receiving report, maybe the requisition, checks the math, any discounts. It's approved for payment.
Then the actual cash disbursement.
Usually paid by check. And again, key segregation. The person approving the payment shouldn't be the one signing the check.
Makes sense.
The treasurer typically gets the approved voucher packet, all the supporting docs, prepares, signs, mails the check, and then they cancel the supporting documents.
Why cancel them?
So they can't be accidentally or fraudulently submitted for payment again. Paid vouchers go back to accounting for final recording and filing.
It's another intricate dance. And auditors test these controls too.
Absolutely. For purchases, check requisition approvals, trace receiving reports, look for PO matching. For accounts payable, inspect voucher packages, check numerical sequences. For cash disbursements, vouch payments back to approved, canceled vouchers.
And always checking for.
Segregation of duties, authorization, purchasing, record keeping, and accounting, custody, receiving, treasurer cash, keep them separated.
Okay, control testing done. Now for the specific evidence gathering, performing specific procedures for expenditures.
Right. For accounts payable, the focus is heavily on completeness. Are all liabilities recorded?
How do auditors check that?
They agree the detailed AP listing to the general ledger. They get statements directly from vendors and compare them. And the big one, the search for unrecorded liabilities.
How does that search work?
They look at cash payments made after the year-end date. If a payment is for goods or services received before year-end, it should have been recorded as a payable at year-end. If it wasn't, that's an unrecorded liability.
Clever. Looking into the next period to find things missed in the current one.
It's a really important test for completeness. They also check valuation footing the list, agreeing totals, existence vouching items on the list back to voucher packages, and rights and obligations, making sure the company actually owes the money.
Do auditors send accounts payable confirmations like they do for receivables?
They can, but it's not required. Why? Because you usually have strong external evidence already, the vendor's invoice, the receiving report, subsequent payments.
So less need for direct confirmation.
Often, yes. But they might send them if controls are weak, or there are disputes, or vendor statements aren't available. If they do, they usually use blank positive forms. And the main goal is testing completeness, trying to find liabilities the company didn't record.
But they can only send them to known vendors, right? So a truly hidden liability.
Might still be missed by confirmations alone. That's why the search for unrecorded liabilities is so key.
Got it. What about auditing the purchase transactions themselves?
Similar assertions again. Completeness. Trace vouchers to the purchase journal, account for pre-numbered documents, cutoff, check dates around year-end, valuation, recompute invoice math, existence, test vouchers for authorization and receiving reports, understandability, check account classifications, making sure expenses are in the right buckets.
And finally, auditing presentation and disclosure for expenditures.
Same idea as revenue. Ensure all required disclosures are their types of payables, purchase commitments, related party deals, check accuracy, valuation, confirm disclosed items occurrence, ensure clarity and proper classification, understandability, is everything transparent.
Wow. Okay, that was a really thorough walk through both cycles. Let's try to connect the dots for everyone listening.
It's a lot of detail, for sure, but the core idea is simple. Revenue cycle, money in. Expenditure cycle, money out. Both need strong controls. Both need careful auditing.
Because without that, the financial statements wouldn't be reliable.
Exactly. That segregation of duties we kept mentioning, that's fundamental to preventing fraud. And the specific audit tests asking, is it complete or does it exist, are how auditors verify those numbers.
So understanding these cycles helps you understand really the backbone of financial reporting. You see the checks and balances.
And you appreciate why those audited financial statements carry weight. They represent a system of controls and verification designed to build trust.
We've covered a lot: the flow of revenue, the flow of expenditures, the controls that guard them, and the auditor's crucial role in checking everything.
It's this constant interplay, this dance between the company's processes and the auditor's scrutiny that underpins confidence in financial reporting. Which leads to a thought.
Go on.
How might new technologies, things like AI or maybe blockchain, change this dance in the future? Could they make auditing stronger or maybe introduce, entirely new challenges?
That is definitely something to think about. A fascinating question for the future. Well, thank you for joining us on this deep dive today.
Hope it was insightful.
Absolutely. Keep exploring, keep questioning, and understand the power of information.